Now, the next event is actually a panel, so I shall do sufficient only by introducing the moderator of the panel. It's talking XVA, a very favourite topic of everyone, most people in this room. Pricing, trading and risk management on the XVA desk, and that's going to be moderated by Milena Imamovic-Tomasovic, who is about? Perfect. Yes. And she's going to moderate the panel, so I'll let her introduce the speakers. See you again. And she does have a fabulous title, Head of CVA Funding and Equity Methodology.
Thank you, Murad. Thank you, George. That was very interesting presentation. As Murad was saying, lots of things to think about. And I guess in this panel, we are going to try to reflect a little bit on the XVA pricing. I guess XVA pricing is going to be impacted quite a bit by all the changes. And in the next half an hour, we're going to try to discuss a little bit on the pricing and modeling methodology, how we actually deal with a regulatory divergence in the market, hedging approaches, and just general trading desk organization. And I guess before we start, I would like to invite the panelists to introduce themselves.
I'm Steve Marshall. I work at Nomura International, where I run a team called Business Resource Management, which looks broadly after all the kind of flavours of XVA, whether that's credit, funding, or capital.
Hi, I'm Jeremy Weiss. I work at UniCredit. I run the CVA desk. Basically, we're responsible for the pricing and risk management of the XVAs. So we look at CVA, we look at FVA, we look at returns on capital, KVA, however you want to consider that.
Hi, I'm Andrew Green. I'm head of CVA and FVA quant research at Lloyds Banking Group, and I run a team that look after the models for XVA, including CVA, FVA, and lastly KVA, capital valuation adjustment, and margin valuation adjustment.
Thank you. I guess to get warmed up, I guess first discussion point is around differences in the pricing. So I guess we've seen quite large differences in our pricing live trades. And what is, in your view, a reason for the large discrepancies that we see in the market?
I'll start up. I mean, over the last 3 or 4 years, we've probably seen a move in the divergence of pricing, but then some convergence, I would say, over the last couple of years, although we still see a number of differences. I guess part of that convergence has come from people's recognition of fairly now standard sort of models with regards to credit valuation adjustments or credit charges, and also recognition of funding charges, albeit, different people have potentially different funding costs or views on funding between firms. But I would say one of the things we've probably seen over the last 2 to 3 years is some convergence in the modelling and how people view those risks. I guess one of the largest problems we are all facing at the moment is capital requirements on derivatives. I think if you go back 2 or 3 years ago, people's view on capital requirements was simply, we've got to make up some markup for these transactions. I think we've now moved to a world where people are putting a label on it, KVA, and sort of saying, well, look, over life, we're going to have a capital requirement on a derivative transaction. That capital requirement varies. It will vary depending on market parameters. It will vary dependent on the credit quality of the counterparty. It will vary dependent on the regulatory rules which are in place at the time, and those are changing. And if you do a 25-year transaction, those changes could be very significant over time. And also those differences, there may be differences between different regulators as well. So, for example, one of the biggest ones which is discussed is corporate exemption given by the European regulators at the moment. And I think that's one of the biggest things that firms are now battling with. Number one, I think most people are now recognising the fact that capital is not a static thing with relation to derivatives. There's something very similar to CVA in that you've got a profile of how that capital will look. But how you deal with that, and the reality with CVA, it's an economic reserve that we can take on day one, whereas capital is still something that's not really recognised. The capital reserve is not something that's recognised at the moment by accountants in any sense. And so how, beyond releasing that as a day one revenue, and then what you do over the next 20 years, the transaction, I think, is the thing that's challenging most firms at the moment and leads to probably the biggest pricing difference that we see on derivatives at the moment. And I think that's only going to get worse as well. At the moment we're talking primarily about uncollateralized derivatives, but with leverage ratio and some of the new rules we're seeing coming in, that will affect pretty much any bilateral contract, even if it's collateralized. I think the only sort of clean pricing we will see in a couple of years' time is fully cleared CCP type risk.
Thank you, Steve. Jeremy?
Okay. I guess I would, I'd echo a lot of what Stephen said. I mean, I think that in terms of acceptance of methodology in the market, I'm not sure if I would call it convergence or acceptance. I mean, I still think we see a lot of differences in pricing, even on the accepted CVAs and FVAs. And I suppose Totem has been very successful in their pricing service. There are now north of 20 banks who contribute to that, and even in that you see differences. I do also see in some of the more local markets the evolution of market leaders versus laggers in adopting these methodologies. So you still see banks who don't fully incorporate the various charges. I'd agree completely in terms of the capital requirement against these transactions being relevant and hard to quantify because the regulations are changing. You're taking a lifetime view of a derivative and changing rules. But even if you take the as is, it's very hard to pull all those things together in a number. But even putting that aside, if you think about it, it's not a price adjustment, it's not a cost, it's a return requirement. It's subject to management hurdles, it's subject to what business is important to do versus not to do, what clients are important, what products. So there's still a lot of subjectivity even in applying the number into to your pricing decision. And the last thing is this idea of the overlap, right? Which is to say that if you fully cook in all your XVAs, you'd be sitting at home and not trading, right? So the prices we see happening where transactions clear aren't additive functions of the XVAs. And there are a lot of theoretical reasons why that makes sense. And Andrew can probably go into that into some more details. But the point is that your construct needs to allow for these overlaps if they are to calibrate to market clearing levels.
So I'll conclude really. I mean, I think from the quant perspective, I think perhaps one of our personal challenges or personal biggest challenges right now is coming to grips with the impact of capital on pricing, and that's certainly something that I'm personally spending a lot of time doing, is trying to get to grips with how you do that and in a consistent manner with derivatives pricing theory. Although it is very difficult to do that. I think I'd allude to there are a number of reasons why you might see a big diversity in pricing, just from the regulations themselves. Obviously, we've been alluded to the extraterritorial issues. There are differences, or quite substantial differences, in certain aspects of the regulatory framework, particularly leverage ratio and the CVA exemption are perhaps the two biggest ones. But even within the basic Basel framework, there are substantial differences depending on regulatory status. So depending on whether you have IMO approvals for your credit risk part, your market risk part, will actually determine and make substantial differences to your capital position and the cost of doing new transactions. So those differences are really quite substantial. So it's quite easy to see how you can get quite big divergences. And as an example of that, I think that there was a study, I forget exactly which number it was from the Basel Committee, I think it's 242 or something like that, which talks about the divergence in market risk, which was part of the regulatory consistency program, which is a program under the Basel Committee to look at how the rules have been implemented. And that looked at IMM implementations of market risk capital. Just your kind of spot market risk capital, the divergence for the same portfolio across the market was enormous. So it's because it's a VaR-based methodology and because it's relatively easy to get big divergences in there. So there's a lot of reasons for divergence, and I think that even if we all agreed on the same model, there would be still substantial divergence in pricing across the market.
Thank you, Andrew. I guess moving on from pricing, in terms of the hedging, XVA, what is your view? Central hedging or separate desks? Can we hedge it? How we can hedge it?
I guess at Nomura we have a central desk to deal with this. We feel it's best and actually optimal to run things through central desk, given that ultimately capital now, credit and funding are arguably, there's huge netting benefits through looking cross-product, cross-desk, etc. From that, and so we find that it's optimal to do that. In terms of the other thing is centralising. One key thing now is centralisation of expertise as well. So expecting every single desk to become, or every single group to become experts in, credit, funding, and I think some desks hold out on funding and some desks hold out on credit. But when it comes to capital rules and what the changes are in capital rules, I think even of those who of us who proclaim to be experts struggle now to keep up. Every week you get 100 or 1,000-page document lands on your desk that's due for review. You need some centralisation just to really understand and comprehend and actually take a view as a firm which way the market's going, because a lot of it is interpretive now. And really, that's the key thing, is it's interpretation and feeling as a firm, not so much what's the specific hedge to do this, but how as a firm do we interpret things? What do we think are the key risks to a firm? And it will vary, firm to firm. For some, collateralization will be a big thing if you have, if you can source collateral and can do that. But for other firms, that may not make sense, and it might make sense to put various, VAR hedges, etc., that are far more efficient. And then similarly, whether your view of economic risk versus capital risk and how management view that. So obviously there's a fairly well-published thing about Deutsche, which everyone seems to pick up on. But in reality, if that's how the firm, maybe you can comment on that. If that is something which the firm is comfortable with, then absolutely, it may well cause an economic loss today. But in terms of enhancing your capital return, surely that should be taken into account now. And it's very interesting how people can very quickly focus on the day one economics and ignore what that means over the horizon of some of these transactions for capital returns and what that means for shareholders.
And I guess that touches to your comment previously, whether day one should be recognized, and if we have a transaction that is very capital heavy under IFRS accounting, effectively you don't have any day one requirement, right? But is that the right thing, right? Should you actually be recognizing that upfront?
Yeah, I mean, to extend on that, I mean, certainly the centralization model makes sense for all the reasons Stephen mentioned. I think that's generally where the firm is getting to. But apart from just the difficulty in risk managing these hard to quantify and constrained numbers, the other aspect that goes along with that is the education of management of the XVAs and how they behave, and trying to explain, well, understand first and then explain the inherent basis risks associated with any kind of active risk management strategy, be it your credit proxy methodology, be it what is observable in the market as data points to calibrate to whatsoever. So we do see a lot of levels of understanding that needs to be reached before you can come to, okay, let's go and hedge these risk factors in this way. And with these XVAs still hitting the market, I think, we certainly still have some work to do to get to kind of the golden target of an XVA desk at most firms.
I also kind of agree that they go together, but I'd like to kind of point out that there are some differences here in the way that the different XVAs apply. So I think it's CVA is relatively straightforward. That's a counterparty level calculation. Funding, it really depends to a degree on how you've modeled it, but Most of the models include, obviously, the overlaps that we've talked about between DVA, particularly in funding benefits, suggests that, again, funding cleanly fits within that. Most of the models do put them together. Where it starts to get more interesting is when you look at the other terms, KVA and MVA. So if you look at capital valuation adjustment and the different parts of the capital framework, it's clear that market risk applies at book level. So that implies that to some degree, although you can manage it centrally, there's going to have to be some engagement or cross trading book to understand and manage that particular piece. The CCR terms apply at counterparty level. The CVA terms apply at counterparty level if you're on IMM, but if you're under standardized rules, then it is actually a book level calculation, although you can approximate it reasonably well with a counterparty level calculation. And then you get to leverage ratio, and that's another book level calculation. In fact, that's actually spanning your entire firm, not just the derivatives part of it. So those are introducing some extra complexities there, and then we get to perhaps margin valuation, cost of initial margin. And then again, that's applying for specific parts of your portfolio facing CCPs, and then eventually under the bilateral margin rules. So yes, I think they go together, and centralization is important, but there's got to be some kind of cohesion across the firm to manage some of the more global aspects of this.
Thank you, Andre. And I guess there have been some suggestions on the street that centralized XVA desk should be the entry point for the trading, and then the XVA desk should be, hedging with the other desk within the bank. What is your view on that? Effectively, because all the expertise of the complex stuff is with the XVA desk, that effectively that should be the street-facing desk.
Yeah, I mean, at Nomura, on the more capital or credit-intensive trades, to some extent we are that entry point, and we probably do drive the pricing of that transaction far more than the trading desk. If you're doing a 10-year uncollateralized cross-currency swap with a triple B or double B corporate, then quite frankly, I would sense my desk has a greater understanding of how to price that than the regular cross-currency swap trader. And I think that's true at probably most firms. So, I think that's the point. I think the other thing as well, it's not simply a case of pricing anymore, because I think certainly a lot of transactions where, say it's a normal sort of LBO approach and maybe there's some of the debt being swapped out, what we find is either the process is syndicated now or there develops a clearing level. And so I think that this, if you look back, say 2 or 3 years ago, people would run their model and say, well, this is the credit charge, this is funding charge. And I think people may now run that and say, okay, well, now I have a kind of capital hurdle. But really the question is, well, actually at this clearing level, do you want to trade or not? And so your capital model has really so many assumptions around it, not simply even because of unknowns, but concepts such as, what sort of, given the netting set that you have, how much, if you put this transaction in your portfolio, if you've got a very, very large portfolio, it may be that incrementally has very little capital impact, or depending on the rest of your portfolio, may be a tall tree in terms of CCR and may have a real problem in terms of the capital. So, from firm to firm it can vary, and also depending on how you view hedging and what you can do around your portfolio. So a lot of the challenge, I think, comes at this clearing level. Is this a transaction we'd like to put in our portfolio? And whereas I think if you move back 2 or 3 years ago, that used to be a little bit black and white through kind of thinking about a hedge cost, a credit cost and a financing cost. I think now a decision around trading is far more grey than it actually has been at any point in the past, certainly the last 10 years, I think.
Yeah, I mean, agreed. Certainly in terms of the decision to do a trade, we are very much involved and are a bigger driver of whether the trade gets done than the flow desk in a lot of situations. But in terms of creating an XVA-centric model of the firm, I think that's probably difficult to achieve for most places. I mean, certainly operationally, it's very difficult for a desk to say take on the booking of all client trades and and being the first point of contact, because certainly one of the things we try to do is to triage the transactions and make sure that we only are involved in the ones that are material. And the second thing is, from a steering perspective, still the model is that I think prevalent is that the business line owns the RWAs, and it's their business to optimize the revenue on those RWAs. And we're service and support in doing so, but still it's kind of a business-led decision. So the XVA desk isn't going to make every RWA call.
So that's raises an interesting point. If the business owns the RWAs, where does it, in terms of RWA mitigation and hedging, does that sit with the business, or does that sit with XVA, or does XVA sit within the business and take on the role of that as a, kind of central manager of that?
Yeah, I mean, certainly, and what that comes to bear is what are the KPIs on either the XVA desk or the business, right? So if the RWAs is a KPI of your business line, then they're incented to optimize to that, and then the XVA desk can help support that with the analysis, the pricing, and whatsoever. So, I mean, I think either model can work, but certainly it's, and it continues to evolve. I mean, I see discussions at our firm evolving in terms of the best way to align the interests and make sure people are motivated to do the right risk-reducing trades. So I don't think there's necessarily a right answer.
I'd like to sort of add a bit to that, and sort of, if we think about the way that the derivatives business has kind of developed over the, since inception, the reason that we have a centralized CVA function that's kind of sits aside from the rest of the trading business is really, to a degree, a function of the development of the business. And the fact that the derivatives business developed on separate asset class lines, and then there was a realization we need to manage counterparty risk, and then we've got funding risk and everything else. And so those global things get put together naturally in a pot, in a kind of central pot. If we started again with all of the knowledge of all of these risks, that may not be the way that the business was organized. And we may have something that was more organized along asset class risk lines, where you're managing specific risks rather than specific transactions. And I think that's probably the way the market is going to evolve over the next few years, is to more of a risk-based rather than a transaction-based approach. There is a complexity there, and that is that the kind of the modeling side as well. If you had a super sophisticated model that was, you were able to manage all of your derivative trades on and value them accurately, would you need to split that between your CVA modeling function and the rest of your quant modeling function? The answer is probably no. Are we in a position where we have the technological and quantitative capabilities to do that fully today? Probably no. Are we a million miles away from that? I'd also say probably no.
Thank you. I guess we are slowly running out of time. So final question. In terms of the, again, going back to the pricing, how much actually of the, how much of the future impact of regulation is already being priced into the market, in your view?
I think what happens is a new regulation comes out, and you probably have a lead time of 3 to 6 months while people absorb it and start to understand it. And then you'll get some people who look at it and go, this could be a really big issue, and start to, and let's be honest, we talk about pricing for things. What pricing really means, if you're the only one pricing for it, it means you're not doing trades. That's the reality of the situation. We're not pricing for it. It means if you're the first person to price something in, it means you're actually not actively doing transactions, because most transactions there's some form of competition. Very few transactions are now done in isolation, and so your ability to price in all costs is not there. So what you actually do is start to see people who say, actually, I think this regulation is going to be very important. This regulation is going to potentially bite me, and therefore I will start to avoid or price, my pricing will be more conservative on transactions that I think will have a bigger capital impact in the future that other people aren't taking into account. And I think we've seen that quite frankly, we saw that with CVA, we saw that with funding, and we're starting to see that with capital over the last couple of years. And we're starting to see, for example, say now on leverage ratio. Leverage ratio is kind of the next potentially big thing. It's still in very, quite frankly, very draft format, and some of the initial Basel III rules where you look at the rules and just go, well, that makes absolutely no sense whatsoever. Yet, if you read it verbatim, then you have to be concerned a little bit. And so there are certain transactions which you may well say, well, look, I know this seems like senseless, but this transaction itself has a very large sensitivity to this particular risk. You know what? This one I may pass on.
Yeah, I mean, certainly if the question is, are all these doomsday scenarios being priced in, the answer is most definitely not. I mean, you'll continue to see this evolution of pricing as, the evolving regulations become more certain. Then you'll have this migration of firms. You're always going to have the leading adopters who take it on first, and the next wave, and then the next, and so we've seen that all along the XVAs, and certainly you'll see that on the capital side, where firms, ultimately are trying either to keep market share, keep the business, trying to justify that they're of a sufficient size to stay in the business. Or that they're big enough and they have a big enough book and they need to be very precise about how they allocate capital, and so will be much more selective in the business that they're doing. So it's at the margins that I guess trades are won or lost.
I'd also agree. I don't think that they are all being priced in. I think you're right in terms of the timescales. That it depends. That then you have a period where there's a variety of people implementing something. I think there's probably a degree to implement something relatively quickly, and then there's a more detailed analysis that follows on from that. I think from the kind of quant hat perspective, some of the problem is that as we get through the regulatory framework, things like leverage ratio, because it's a global adjustment, is very difficult to model. There's another piece which you haven't spoken about so far. That's prudent valuation. That's coming in real soon. Looking at reporting, next year for that. That's going to have a big capital impact, and then obviously because it's got a capital impact, you've got to think about how you price it. And some of the elements in that are really, really difficult from a quant perspective to manage. So I don't think we're there yet, and it's certainly a big challenge, but it's kind of what my day job is. So
I guess from the quant perspective, if we want to calibrate from the all-in prices, what is your view on that? Because that's the only thing that we have, right, from the market.
It's very difficult. It's very difficult because you've got so few real observations. I mean, things like Totem have clarified to some degree, and there's quite a lot of information in the Totem survey that you can use and get a good feel for what's actually going on and what people are pricing in. So that's quite useful. So sources like that are very useful. Individual transactions. It depends. Sometimes you get feedback, sometimes you don't get feedback. If you win the deal, you've got a good idea, where it traded. If you didn't win the deal, sometimes you get feedback, sometimes you don't. It's a very difficult problem to do. I mean, there is an apocryphal story that there are banks out there that have implemented everybody else's model and everybody else's capital framework, so that they do know where everybody else is pricing the deal. But maybe we'll get to that at some point. But.
Thank you, Andrew. Any final comments from the panel before we move to the questions?
And I think one of the biggest things as well, and maybe a comment for this audience, is that I think in the past, if we look, the people who were biggest hit first were those uncollateralized, so corporates. But with leverage ratio and certainly clean, the requirements of CSAs and how those are changing and margin, I think the cost of all trading away from CCPs is going to increase. This is not just something which is going to be limited to uncollateralized transactions, but unless you have cleared transactions, and the way the leverage ratio rules stand at the moment, unless you take very aggressive views in how people are going to turn over their portfolios, which in reality very few firms do, the cost of trading for people will go up. And we're not talking 1 or 2 times what market bid offer is. It's actually very scary when you look at the numbers.
And I guess the other comment is that certainly all this regulation puts an increased cost on the banks. As we're saying, all these XVAs add up. And certainly as an industry, one of the things that needs to happen is that, this needs to ultimately get communicated to the end users about why the prices are what they are and why they need to be what they are, and why, if banks are to serve this risk management function, they should be compensated for doing so. So, it's hard to do that when you have kind of this uneven playing field of regulation and adoption of the XVAs. But certainly, if you want to take a glass half full view, you look forward 5-6 years and there'll be greater understanding and acceptance of the cost of actually running these businesses, and corporates who need to hedge or financial counterparties who need to trade will absorb some of this cost as well.
So we're hoping for steady state in 2020?
Potentially.
And
just a kind of perhaps a comment on costs and costs. It is clear that this whole process is throwing a lot of light on the cost of doing business. This is kind of what happened, I think, in other industries like manufacturing industry some time ago, and that being a successful builder of cars, it required you to have a very detailed understanding of what your cost model was. And this is really, to some degree, what XVA is about. It's about understanding what your costs are.
Thank you. And I guess with that we can open for questions. Yeah.
Hi, Robert McWilliam from ING. If we heard from George's presentation that obviously the regulatory incentive is everything to go towards clearing, how much business is going to be left for the XVA desk once all your financial counterparties are either bilaterally margined with initial margins, so presumably very little XVA, or the rest are cleared? Even your big corporate counterparties are going to be collateralized. What are you going to be left with?
Management of IM and VM at CCPs. Now, I said that semi-jokingly. I mean, quite frankly, if as a shareholder of the firm, that's a far better model. We'll be far more efficient users of capital through people moving to that sort of model, and will make the world a lot simpler. So I think the view that, people always say, CVA was a great place to work, and FVA, now XVA is a great place to work for job safety. I would argue as an industry and as a shareholder of my firm that actually arguably the reduction of the XVA desk to make our job simpler is actually beneficial. And I do think that I think the reality is that the industry it's not going to case of everybody against CCP. I do think the bilateral market over the next 5 years, over the next 10 years, will drop off a cliff. Not just because everyone goes to CCPs, but I think the cost of trading will change significantly, which will cause a drop in that, and people will migrate to CCPs. But the reality is, I think our industry in the bilateral world is going to see vast changes, really vast changes.
Did you want to add anything, Andrew?
Yeah, I would just add, MVA, basically. I mean, that's the kind of solution to that. Building an MVA model is a challenging topic in of itself. You're looking at lifetime evolution of basically a VAR model. That's has all kinds of interesting challenges embedded in it.
So it should keep us busy for a while. Thank you. Any other questions?
See, banks typically get, your opinions are asked by, and you're members of ISTA and such committees, right? So is there a consensus building which is happening in valuation methodologies? Because on FVA or, one of these valuation adjustments that you have to provide, because ultimately you're holding it in your books using different methodologies, right?
I think compared to, say, other trading desks, there's somewhat communication between firms as to regards the direction of methodologies and direction of approaches, and the view that people don't want to be because a lot of this is regulatory driven, because a lot of it is accounting standards driven, there is a desire not to be too far from the kind of median, and so there is a move to that. And I think also accountancy standards are now moving us towards a sort of common approach. Having said that, I mean, just two very simple things. So, CVA, how people use models to determine, say, some people have models to determine credit spreads for various, market, sector, region, rating type approaches, how those differ and how people, how that can affect pricing of CVA. Or simply on FVA, how people fund it, view funding, whether they view their, FVA as a transfer pricing cost from, say, internal treasury to the derivatives group, or whether they view it as an average funding level or clearing level for derivatives in the street. And, I think the totem, survey for that has proved very interesting in that people have different views on that, and whether we see convergence for that is a challenge. So I think, if you look at CVA now, we are slowly getting closer and closer. FVA, I think we all know where the main differences are. Capital, I still think there's a lot of challenges, some of which are very different between firms. So particularly whether your regulator is European, US or Asian, you will have a very different view on your future capital costs. But I do think as an industry we tend to come together at forums like this, and there is probably a little bit more discussion around things than in some other areas of finance.
Perhaps I'll add just on the modelling side, the exposure engine, which is a kind of core component of a lot of these calculations, there is obviously some variations in how that is implemented and the actual models that are used in each case. But because it's a cross-asset calculation, there is a limit to how much variability is still analytically and computationally tractable. So that's why I think they all look relatively similar, although there's some degree of variation in calibration. So those parts of the model probably relatively standardized. Yeah.
But I guess we have to look at it from the all-in price perspective, right? And I guess as we've seen from the totem pricing, there is still reasonable dispersion in the market in terms of all-in prices.
Yeah, even how Totem asked the question, for those who are aware of that survey, which is really basically saying to people, what are your FVA reserves against various transactions? I think if you say to your finance guys, okay, where do you actually have this FVA on your books and records? That's one question versus asking people where you actually commit a transaction with the firm. That can be two different things. So particularly if you've got concepts like transfer pricing versus what you believe your real in all long term of cost of funds is, and have a true funding curve against that, are two very different questions. And the reality is, if you have expensive funding, do you sit around twiddling your thumbs, not doing any transactions because that's the outcome of you having expensive funding, or do you have a view that, well, actually we have ways of mitigating that, and there are within derivatives trading, there are ways of getting derivatives funding within the firm as well, and do you have a view that in terms of pricing I take a more balanced view there.
And Milena, thanks. A very fine piece of moderating, thank you. Right, for me, I thought the comment at the end, actually the top and tailed, for Mr. Marshall, if you are receiving 1,000-page documents on your desk, you have my sympathy. And Mr. Green's comment at the end, absolutely, it boils down to the cost of doing business, and some banks have more competitive and indeed comparative advantage in derivatives trading than others. So ultimately, one should see the strategic decision made that that there isn't any mileage in this particular line of business, for example, cost of funds, because they are, of course, specific to each bank. So my thanks again to the panel. Appreciate it, everyone.